Imagine investing in a company and holding that investment not for days, not for months, but for decades. Now imagine that single decision turning a few $1,000s into millions. This is not a fantasy. This is exactly how the greatest investors in history built their wealth. When people think about successful investing, they often imagine complex formulas, high-frequency trading, or secret insider strategies. But the truth is far simpler. Some of the most powerful investing lessons come from a philosophy built on patience, discipline, and long-term thinking. These ideas have helped build one of the greatest investment track records the world has ever seen. And the most interesting part, anyone can apply these principles. In this video, we'll explore some of the most powerful investing lessons inspired by the philosophy of Warren Buffett. Lessons that can completely change the way you think about money, risk, and long-term wealth. Lesson 1. Think like a business owner. One of the biggest mistakes many investors make is treating stocks like lottery tickets. They buy because the price is rising. They sell because the price is falling. But successful investors think differently. Instead of asking, "Will this stock go up tomorrow?" they ask a completely different question. If I owned this entire business, would I be happy holding it for the next 10 years? This shift in thinking changes everything. When you buy shares of a company, you're not just buying a ticker symbol on a screen. You're buying ownership in a real business. That business has products, it has customers, it generates profits. Great investors focus on businesses with strong fundamentals. They look for companies that have strong brands, produce consistent profits, have loyal customers, and possess long-term competitive advantages. This approach transforms investing from speculation into intelligent ownership. Lesson 2. The power of long-term thinking. One of the greatest advantages an investor can have is patience. Unfortunately, patience is extremely rare in financial markets. Many investors want quick profits. They chase the hottest stocks. They follow market hype. They constantly buy and sell. But long-term wealth is rarely built that way. The stock market often rewards those who think in decades, not days. When you invest in strong companies and allow them time to grow, something powerful begins to happen. Your money starts compounding. Compounding is one of the most powerful forces in finance. Small gains, repeated consistently over many years, can create extraordinary results. A company that grows earnings year after year can turn into a massive wealth generator for long-term investors. Patience allows compounding to work its magic. Lesson 3. Ignore market noise. The stock market can feel like an emotional roller coaster. Prices go up, prices go down. Financial news channels constantly talk about crashes, rallies, and economic predictions. But successful investors understand something important. The market is often driven by emotion. Fear and greed dominate short-term movements. When markets fall, many investors panic and sell. When markets rise, many investors become greedy and buy at high prices. Great investors try to do the opposite. They remain calm when others panic, and they remain disciplined when others become irrationally excited. Instead of reacting to daily headlines, they focus on long-term business value. Lesson 5. Invest in what you understand. Another powerful principle of successful investing is simplicity. Many investors feel pressured to understand every new technology or trend. They chase complex industries they barely understand. But great investors know their limits. They focus on businesses they truly understand. If you cannot clearly explain how a company makes money, how it competes, and why customers continue buying its products, then investing in that company becomes risky. Successful investing does not require understanding every industry. It requires understanding a few businesses extremely well. Lesson 6. Look for competitive advantages. Some companies survive for decades, others disappear within a few years. The difference often comes down to competitive advantage. A strong company usually has something that protects it from competitors. This could be a powerful brand, unique technology, massive distribution networks, customer loyalty, or high switching costs. These advantages create a moat around the business. Just like a castle surrounded by water, a business moat protects profits from competitors. Companies with strong moats often generate steady growth for decades, and long-term investors benefit enormously from this stability. Lesson 7. Price matters. Even the best company in the world can become a bad investment if you pay too much for it. Successful investors pay close attention to valuation. They look for opportunities where the price of a stock is lower than the true value of the business. This concept is often called a margin of safety. Buying with a margin of safety helps protect investors from mistakes, unexpected events, and market volatility. In simple terms, great investors try to buy wonderful businesses at reasonable prices. Lesson 8. Emotional discipline. Investing success is not just about intelligence, it's about emotional control. Many investors understand the right strategies, but when markets become volatile, emotions take over. Fear can cause investors to sell good investments. Greed can cause investors to chase overpriced stocks. The ability to remain calm during uncertainty is one of the greatest advantages an investor can develop. Long-term wealth often belongs to those who stay disciplined when others lose control. Lesson 9. The magic of compounding. One of the most powerful financial concepts ever discovered is compounding. Compounding happens when your investment returns begin generating their own returns. Over time, the growth becomes exponential. At first, the progress may seem slow, but after many years, compounding can produce incredible results. This is why starting early can make such a massive difference. Time is the investor's greatest ally. The longer your investments compound, the greater your potential wealth. Lesson 10. Simplicity wins. One surprising truth about successful investing is this: simple strategies often outperform complex ones. Many professional traders attempt to outsmart the market using complicated systems, but long-term investors who focus on quality businesses and patience often achieve better results. Investing does not need to be complicated. In fact, simplicity is often the key to consistency. Final message: building wealth over time. Building wealth is not about getting rich overnight. It is about making intelligent decisions consistently over long periods of time. Successful investors focus on great businesses, reasonable prices, long-term thinking, and emotional discipline. They understand that markets will rise and fall, but strong businesses continue growing over time, and patient investors who allow compounding to work can achieve extraordinary results. The journey of investing is not about predicting the next market move. It's about building ownership in great businesses and giving those investments the time they need to grow. Because in the end, time, patience, and discipline are often the greatest investment advantages anyone can have.